Hi, and welcome back. This is Charmin with the Trade Masters channel. And today we are going to go over something super important, a trading plan. So if you don't have one and you are new and you don't know what to look for before you jump in the market, stay tuned. I'm going to roll through a few of those, okay? See you in a minute. And remember, if you have not done so, please like and subscribe so you can continue to get updated videos. See you in a second. So here is the $1,000,000 question. When is the best time to trade? When should you get into the market? And in short, the answer is when the conditions are met according to your trading plan and those things that are on your checklist. But the other question is, what type of trader are you? Because you may determine your trading plan based on the type of trader you are. So let's take a look at 4 popular trading styles there are. This is not all of them, but this is just the 4 most popular. You've got the scalper, the day trader, the swing trader, and the position trader. Now, here's the thing. You may start off as one thing and then graduate to another, or should I say transition to another, or you may add another layer. For example, if you're a scalper, you're somebody that wants to be in the market for a short period of time. You're going in for short moves, not a heck of a lot of pips, unless, of course, you're trading something that's extremely volatile, but you're in and out. Minutes to a couple of hours is where you're comfortable being in a trade. Unlike a day trader, it takes all day, hence the name day trader. They want to be done pretty much within a 24-hour time span. And then the next day, they find setups that they trade. Then there's the layer of the swing trader. The swing trader can be in the market for hours or days at a time. A position trader takes much longer. They're going in for those long moves that could take months or even years. So you can be one or you can be more than one. For example, I can be a swing trader where I'm looking to find a position and get into the market, and I might be there for a week. But within that week, I'm finding smaller moves within the larger move that I can scalp. So hence, you can be a scalper and a swing trader. You can be a day trader. You can be a scalper. You can be a combination of all 4 if you like. But whatever you are, make sure that you have a trading plan that you are following so that you're not just going into the market without any thought of who you are as a trader. Now, the next slide I'm going to show you just gives you a handful of the type of trading plans that you can have. Is this all there are? No, it's not. There are way more than this. This is just a few of them that you may think about, especially if you're brand new, you're just funding your account and you think you're ready to go into the market. Just please consider a trading plan. You may want to trade a specific pair. For example, there are a lot of people, I like US 30, even though that's not a pair. I like to trade US 30. Other people like to trade GBP pairs and so forth and so on. And I'm going to break each one of these things down. There are other people that want to trade a specific day of the week or days of the week because market moves faster or better on those specific days. Then you have others that want to trade a particular session, others that want to look at particular indicators on their trading view for confirmation. There are some people that say, okay, forget all of that. I'm just trying to get X amount of pips out of the market a day. And then others are saying, I just want X amount of dollars out of the day. Then there are some people that use a combination of these things within their checklist. But whichever one you are and whichever one you choose to do, make sure that you have a clear mental and emotional state, because we don't want emotions to get in the way of logic. And no matter what plan you follow, just make sure you're following the best possible trade setups so that you can have the most probable outcome. Take a look at that very first one, currency. Some people trade currencies, and I get it because there are some currencies that I just like better than others. I don't really deal with chef. I don't, unless I'm trading high frequency Forex. Regular Forex, I don't deal with chef. I just don't like the way it moves. So there are some things that people look at and say, okay, this fits my personality or that fits my personality, because currencies have personalities. They're like people. Some move faster than others and some move very, very slowly. And when we're talking about that, we don't call it fast or slow. We refer to it as volatility. And it's just how fast the market is moving. And the more volatile the pair, the shorter move or the smaller move it makes, but it's packing a big punch within that small move. When I have new people join my trading community and they're kind of anxious a little bit and they're kind of scared, but they're still wanting to learn how to trade, I start them off with the odd pairs because of the low volatility. And then if they graduate, and it doesn't take them long to graduate to the GBP pairs, they move very fast. The fastest moving thing in the market is going to be like your US 30, your German 30, things of that nature, your futures, your cryptos. Those things move extremely fast. They're called high volatility pairs or currencies. So there are pros and cons when you're looking at a high volatile pair or high volatile market versus a low one. And I have them listed here. Let's just talk about it for a second. If you're going into a market that moves really fast, then yes, you're going to make your money a lot faster. You're going to compound your account much faster. But if your analysis is off, you're going to lose your money that much faster as well. So you have to be very, very careful. The faster the market moves, it could also cause you a lot of anxiety once you're placing your trade. And it's very easy to over leverage because you're looking at what looks like a small move in the market, but that small move carries a big punch. Now let's look at the contrast, a low volatile market. So when you're trading a pair that doesn't move as fast, it allows you to have your analysis done that much easier because the market is a bit more steady. You're also going to have less anxiety and it's a bit more calming. However, the flip side of that is that it's going to take you time to make your money because the market is moving a bit slower and your account is going to grow a lot slower. Some people like to trade based on the day of the week. Now, does the market move every single day that it's open? Yes, it does. However, there are some days that tend to be better than others repeatedly. Tuesdays through Thursdays are my favorite times to trade. Thursday being my favorite day of the week to trade. However, if the trade setup fits other things on my checklist, then I will take the trade. With that being said, there are 4 trading sessions that we take a look at, and there are particular times that these markets are open. You have the Sydney, Tokyo, London, and New York session. Notice that each one of these sessions are given in Eastern Standard Time. So wherever you are in the world, make sure that you adjust your time accordingly. Now, the Sydney session is the slowest of the 4 sessions. Remember, I told you that the odd pairs are the slowest pairs. Well, now it makes sense because the Australian market is the slowest market. However, I want you to take note of something. The Sydney session opens up at 5 o'clock in the evening, closes at 2 o'clock in the morning. However, the Tokyo market opens at 7, which means that there are times where those markets are open at the same time. That is called market overlap, which leads me to my next trading plan. Some people will only trade market overlaps because it's 2 major banks being open at the same time. I liken it to a person being at work by themselves and they're stocking shelves. Well, there's only so much work that person can do by themselves. And then another person clocks in, now they get double the work done. That's kind of how market overlaps work. So there are some people that will only trade those overlaps because they know 2 markets together creates more volatility. Next, we have confirmations by the way of indicators. So I'm going to do my favorites indicators video. So make sure you like and subscribe so you can get the notifications for when that comes out. So when you're looking at your indicators, there are some pros and cons to that. The pro is that it adds ease of mind because it allows you to trust your analysis. If your analysis is right, your indicator should line up to say, yes, that is correct. Here is the problem with that. You can become dependent on your indicators and you think your indicators will always tell you what you need to know. And if you don't know how to use your indicators together, And I'm telling you now, if you're going to use indicators, always use multiple indicators for multiple confirmations. So you can grow too dependent on your indicators and you're not a real trader. And we want you to know how to analyze these charts for yourself. Some people trade based on pip goals and they adjust their lot according to their desired return on their investment. If you look in the center, it shows you that this is 15 pips. Everybody used 15 pips in this example. The only thing that was changed was the lot size. In the first row, you see where there's 1.0. Well, in the world of Forex, that's $10, also referred to as a standard. The next one under that is $30, 3 standards, $50, so forth and so on. You get it. If you look all the way over to the right, now you see how just adjusting your lot size can alter the return on your dollar. Same analysis, same amount of pips. The only thing you did was adjusted your lot size. Now, when you're trading based on a pip goal, it does create a disciplined trader. Once I've met my goal, I'm done. I don't touch the market. I go on about my day. I'm not tied to my charts all day. I have another life, right? The con to that is that if you don't really know what you're doing, you may miss the mark and not yield the desired amount of pips. However, in this community, we can do 15 pips in our sleep. So if you're trading based on pips, keep in mind that if you're for your smaller moves, you can increase your lot sizes. This is not advice. This is just observation, because I want you to make sure that you exercise proper risk management. There are some people that trade based on a compounding plan, and I have one. I'll put one. So email me if you want the compounding plan. No, I'll put it in there. I'll put it in the description below. Yeah, I'll put it in the description below. But there are some people that trade based on a compounding plan, and once they reach their financial goal, just like the tip goal, once they reach the goal, they are done. They are no longer trading. And if they just have an itch to trade, then they may trade on their demo account just to see how things have played out. Now, with this plan, you can grow your account exponentially, and you know what to expect. You already have it mapped out. There are some people that will trade based on a percentage of increase, and then there are some people that trade based on a dollar amount. They may want to grow their account by 3% or 5%. And 5% is rather steep, so you really need to know what you're doing if you're going for the 5% increase. And then there are other people that said, okay, I want $100 out of the market a day or $500 out of the market a day. And once they, like I said, once they reach that goal, they are done. Now, whatever trading plan you decide works best for you, based on the type of trader, based on your emotional makeup and your mental space, just make sure that you are taking the most probable trades. Because again, we want to protect our investment. Always have a clear mind. You want to analyze your charts before you're trying to trade it. So I told my traders, analyze your charts, mark up your charts, do your top-down analysis over the weekend when the market is closed. That way you're not jumping in cold and trying to figure out a trade and trying to make some money. You never want to go to the market thirsty, because you'll make amateur mistakes. So mark up your charts, put little notes on your charts so that you know what to do. When you trade, it should always be based on an if-then. If I see this, then and only then will I take the trade. Knowing when to avoid trading can be just as important as knowing when to trade. So again, always make sure that your emotions are in check. Make sure that you have a good trading plan, that you are exercising proper risk management, and that you are plugged in with an amazing community. If you need a trading community, please reach out to me. My information will be in the description box below. And like I always say, God bless, and I will see you in the market.